Welcome everyone to Wealth Office Hours Live. This is Matt Sorensen. What an incredible day today. Crypto markets have crashed. Bitcoin is now trading at $63,000 per BTC as we are talking right now. Now there is a lot of panic and concern, which is absolutely to be expected. But what I want to talk about in today's live is how you can take advantage of that volatility by using two tax strategies. Now, this is for people who believe in crypto. I'm not talking about getting out of the crypto market. I'm talking about how can I do a strategic move right now while the market's down that's going to save me on my tax return and keep more money in my pocket as I'm trying to grow and build wealth. Now, the first I want to talk about is crypto tax loss harvesting. This is a strategy that gives you a tax loss on your tax return. It's called the tax loss harvesting rule. And there's some unique rules for crypto that I'll get into here where we can use these losses, and you can't do the same thing selling stock or real estate as a loss. So I'm going to dig into that, something called the wash sell rule that's unique to crypto. But bottom line, there's a way I can sell the crypto, get a loss, use it on my tax returns. But it only works when markets fall like they have today. Now, the second strategy we'll talk about is how you can reposition your portfolio in crypto into a tax-free vehicle. So now if you believe the market's going to go up, how do I have that increase in value and net worth to me in an entirely tax-free manner? We're going to talk about that using a crypto Roth IRA. Now, keep in mind, both of these strategies are only if you believe in crypto and that it's going to go up in value. These are not strategies to get out of crypto, take the ball, leave the court, and go home. I'm not talking about that. I'm talking about rebuying crypto, making a strategic sell and rebuying it and repositioning yourself in a more tax-efficient way. All right, so let's talk about the first strategy here, and this is crypto tax loss harvesting. Now, the first thing I want to make sure we all understand is crypto is taxable. The IRS has been explicit about this. It is a question on the first page of your 1040 tax return that says, have you made any money on crypto? There's a box you have to check to say yes or no. Now, let's go over some foundational crypto tax rules. Crypto is taxed like property, not like currency. Now, the IRS issued a notice on this way back in 2014 called IRS Notice 2014-21 that clarified that the loss sell rules and the gain rules when you're making money buying and selling crypto are the same as other property like stock or even real estate. Now, there's some unique rules between each of the assets, but the key thing is here, it is property. So when I sell it for a loss, I can use that loss on my 1040. So just like stock, where I can claim a loss on my return, or real estate, when we sell this crypto for a loss, it shows up on our 1040 and can offset other gains or income that we have. Now, we have two different types of gains and losses. First, we have short-term gains or losses. What this means is I've owned the crypto or whatever the asset is less than 12 months. So if you just bought crypto for 100K 6 months ago, let's say, and now you're going to sell it today at 63 grand, well, you're going to have a $37,000 short-term capital gain, capital loss. All right, now it's important. I'm going to come back to short-term losses and long-term losses here in a second. On the flip side, let's say you own this over a year. Same thing here, bought for 100K, sold for 63. I have a $37,000 loss. That is a long-term capital loss that I will use to offset other long-term capital gains. Now, when you're making money on crypto and you're selling it for a gain, again, it's the same timing rules here, whether it's long-term or short-term. The important distinction here is when I sell and I have a long-term capital gain, I've owned it over a year, I get a reduced tax rate. It's a 20% maximum tax rate, no matter your income level. On the other hand, short-term capital gains, you pay out ordinary income tax rates. Now, for those of you that may be middle income or lower income, there are some strategies where you might not even be paying taxes at all. If you're married filing joint under 100K, your long-term capital gain rate is 0. So this would not be applicable to you. So, but as your income goes up in the income ladder, you're making over 100 grand married filing joint, you're going to have taxation on your gains and losses, even your long-term gains and losses. So what we're going to talk about here is now taking a loss and using this tax loss harvesting rule. And this is strategy number one. All right, now let's get into that here. Strategy number one, harvesting losses for tax loss harvesting rules. Now, let's go back into where we're sitting today. BTC is at $63,000. I bought it. Let's use the same example for 100K. I have a $37,000 loss. Now, under the tax rules, that loss is going to show up on my 1040 on Schedule D. We'll talk about this here more in a minute. And I get to use that loss to offset other gains that I have. Now, the unique thing about crypto is I can rebuy the same crypto 10 seconds later. So I can lock in the loss, but even though I believe the asset's going to go up in value, I can rebuy that crypto immediately to make sure I don't miss out on the appreciation that I think might come right back around. Now, this is a unique rule for crypto. You cannot do this with stock. In your stock portfolio, IRS got super nervous about traders basically taking losses on their stock portfolio when the market went down, and they'd rebuy the position the next minute or day later. And they said, that's not great. We're letting them, they're not really realizing a loss. They're staying invested in the asset, but they're taking this loss to offset other income on their tax return. We don't like that. That doesn't make sense. So they created something called the wash sale rule that says, hey, if you sell stock and you rebuy that within 30 days, you don't get to take the loss. All right. It's called the wash sale rule. Now, the important thing and the reason I'm bringing this up is the wash sell rule does not apply to crypto. So I can sell that crypto for a loss and I can immediately rebuy it 1 minute later and reclaim that position. The benefit, of course, here is that loss, which I really haven't realized because I went right back into the asset. It's a paper loss here, right? You went from BTC at 63,000 for 63,000 in your account back to buying BTC, right? You're just making a transaction to get a tax loss on paper. Now that $37,000 loss is hitting my 1040. And we're going to talk about how you use that here in a second. But that is the concept of tax loss harvesting. What we're talking about here is selling when you have a loss on an asset, locking that in. You have to make an actual transaction. Now it's available and it can hit my 1040 and I can use it to offset other income. All right, now let's talk about how you practically execute this. We went through the example there. I've got the let's say $37,000 loss. I'm doing my tax return. How do I actually do this? Well, the first thing is we need to identify is, was that loss a long-term loss or a short-term loss? Okay, because you're going to be filling out something called Form 8949. This is part of Schedule D on your 1040, where you report gains and losses on stock, crypto, and all that. And on this 8949, what you're going to be doing is saying, hey, I had a $37,000 loss when I sold BTC, and you're going to say this was short-term because I bought it and sold it within 12 months, or long-term, I held it over 12 months. Now that's important because short-term losses get netted against short-term gains. Long-term losses get netted against long-term gains. All right. So let's say you have other stock you've sold or crypto you've sold earlier in the year for a profit, or that you do later in the year in 2026. Those are going to get bucketed into short-term or long-term as well. And you get, and the short-term losses offset short-term gains, long-term losses offset long-term gains. All right. But I can mix and match a little bit there with stock, with crypto and stock. So I can match up those losses that I might have. Now, let's say in 2026, you don't have any gains. You just have this $37,000 loss in the example I've given that hits your 1040. And you're like, Matt, I didn't sell any stock or crypto for a gain. I'm holding everything else, but I did your strategy here and I locked in this $37,000 loss. What happens next? Well, the IRS lets you take $3,000 of those losses to offset your other income. This could be W-2 income, business income, other self-employment income. It doesn't matter. You get to take that loss up to 3,000, that can offset your other income. Now, so that whittles me down to $34,000 in this example. Now, that other $34,000 is going to sit over on your Schedule D and will carry forward into future years. Now, when you're carrying it forward, what that means is let's say this was a long-term capital loss. It will sit on my Schedule D on my 1040 as a long-term capital loss to use against future long-term capital gains. And if you believe in crypto, eventually you're going to sell this crypto or other crypto or stock, whatever your investment portfolio may consist of, for a gain, and that loss will help you someday. And at worst case scenario, you start taking $3,000 every year and chipping away at that $37,000, because we can at least get $3,000 every year over to your W-2 or 1040 that will be saving you on taxes. I mean, at least let's say you're in a 1/3 tax bracket, state and Fed, we're at least saving $1,000 in taxes by using this strategy here. Worst case scenario. Best case scenario is it's offsetting some other gains we have where we would have otherwise paid tax, but because we locked in this loss, it would offset that taxable gain and leaving us in a better tax position. All right, now that is crypto tax loss harvesting. Remember, the unique rule for crypto is the wash sell rule does not apply. I can immediately rebuy that crypto. A couple other practical points you need to make sure you understand. There are different rules on how you characterize and when you sell crypto. Let's say you have multiple buys of BTC. Well, how do I determine which lot here I am selling? There is something called spec ID or specific ID, where you can identify the specific crypto purchase of BTC. Let's say you have 5 of them over the last 3 or 4 years, and you want to say, well, I want to be very specific on which of those buys I am selling now for a loss. You can do that. It's something called spec ID. You want to be careful when you're selling it that you're selling that specific buy. This could be tax lot. Sometimes it's called specific ID or spec ID. But crypto itself has a unique characteristic, right? Even Bitcoin in of itself is unique on the blockchain. So you can be specific as to which BTC you're selling. There's other rules of first in, first out, last in, first out, all this other stuff that you can implement and such. But the easiest and probably best way for traders or any of you trying to implement this strategy is using something called specific ID when you're actually selling and taking these losses, and then completing Form D and this IRS 8949 when you're doing your 1040. Now, if you have a savvy tax advisor, they can certainly help you with this, and this will be handled on your 1040. This is becoming a much more popular strategy. It's something that's been used in stock trading for a long time as well. They just have to deal with that wash sell rule. But for crypto, this is still a little bit new for a lot of accounts and advisors. So just want to flag that there so you're hip to it. Now, there's a lot of great tax advisors that know what we're talking about. There's probably some here listening, maybe someone from the Main Street Tax Pro Network. This is a great group of tax advisors that can help you on some of these strategies. The attorneys at my law firm, KKOS Lawyers, advise clients every day on different strategies on how they can save on taxes. There's many. I'm just giving you 2 here that I'm trying to highlight that matter today, and you can implement today because the market has gone down. All right, let's pause here for a second, though. And I don't know if we have any questions on crypto tax loss harvesting. If you have a question on just tax loss harvesting here or the crypto tax loss harvesting strategy, let's see if we have any right now. If not, I'm going to come back for questions, and I want to talk about the second strategy to implement right now as the crypto markets have fallen. So let me check in with Jordan here.
So no questions on tax loss strategy. We have some questions on crypto. We can hit those now if you want.
Let's hit them. Let's
All
see
right,
what
let's
we
do
got.
it.
Let's see.
All right, we got Katara Appa. She's asking, I'm assuming a she, why can't I transfer crypto from my crypto IRA to my personal wallet?
Ooh, good question. Well, since that's the next topic I'm going to talk about, let's maybe segue to that and tell you what is a crypto IRA. And we'll go over some of the rules on that, because that is strategy number 2. And that's actually a perfect question, because what I'm talking about here in this next strategy is repositioning the crypto you own and owning crypto in a Roth IRA. Any crypto you personally own right now, we can't move that into a Roth IRA. Okay, I want to be very clear about that. The crypto you own right now in your personal name will stay in your personal name or you will sell it. I can't move the specific crypto you own or that asset into your crypto Roth IRA, which we're going to talk about here in a second. There's something called the prohibited transaction rule that restricts you from moving assets you already own in your personal name to your own Roth IRA. But let's explain what the hell a crypto IRA is here for those of you that don't know. Many of you on here do. We've got thousands of clients, hundreds of millions of assets for clients that have bought crypto using their Roth IRA. I got into this strategy way back in 2017, where I had my clients, and I was a tax lawyer back then. Directed IRA didn't even exist. And I had a lot of clients asking me, hey, can my IRA own crypto? Can it own Bitcoin? And I didn't even know what those things were back then in 2017. We were helping clients use their IRA to buy real estate or private funds or stock or small businesses. And that's what self-directed IRAs in general have done, what we do at our company, Directed IRA. So in 2017, this was very cutting edge pioneering. I think I might have been one of the first people to ever have done this. I really do, because I didn't know anybody talking about this in 2017. I wrote the #1 book on how IRAs can own alternative assets. And I'm like, this question keeps popping up. I need to figure this out. So in 2017, I used my own retirement account to buy one BTC for $2,500. And it was an experiment that was amazing because that's gone up significantly in value. But this got me into this realm of how can your retirement account own crypto? Now, again, this is if you believe in the long-term upside of crypto and you believe it's a smart asset to own. Why not own it in a Roth IRA? We all know about Roth IRAs. The growth and the distribution coming out is entirely tax-free. And yes, your Roth IRA can own crypto. A lot of people are familiar with Roth IRAs and they think, oh, my Roth IRA can own stock or a mutual fund or an ETF. Yes, when you have a Roth IRA with a broker dealer and that's the assets they sell, that's what you know and what your Roth IRA can buy. But if you have a Roth IRA with a self-directed provider like our company, Directed IRA, we don't care what you want to buy with your Roth IRA. We don't give advice or make recommendations. We're not making money on the investment asset. You can buy whatever asset is allowed by law. And crypto is allowed as an asset in your Roth IRA. So if you believe right now crypto is at a low point and you think that this is a dip, it would be a wise decision to reposition your worth into a Roth IRA and use that Roth IRA to buy crypto when BTC, let's say, is at 63,000 per BTC. If you think it's going to rebound back to where it's been previously or hit all new time highs, whatever your time horizon and investment thesis is, it would be very wise, because remember, the money you make in a Roth IRA is not taxable. And when it comes out later in retirement at 59.5, it comes out entirely tax-free. Also, when you're trading, there's no capital gains tax on trades. If I'm someone that day trades crypto all the time, all those trades are showing up on your 1040 and you got a lot of paperwork and stuff happening on your tax return. When it's happening in your Roth IRA, there is no tax as you're buying and selling. And then, of course, the long-term wealth and value coming out later at retirement is coming out entirely tax-free as well. So let's say that you bought, let's just give a quick example here. Let's say you bought Bitcoin a while back for 25,000 and that it's now worth 125K. All right. I'm just giving quick examples so I can do the math and you can get the concept here. Okay. So what do we have? We have a $100,000 gain. And let's say this was over 12 months. Now, if you bought this personally and you sold it, you're going to have a long-term capital gains rate of 20%. And let's say you're in a state that has a 5% state tax rate. You could be in a zero tax state. You could be in a 13% tax state like California. But let's say you're in a state that's 5. Let's just go with the middle of the road here. That means you're in a total effective rate of 25%. That means you're going to have a $25,000 tax on that 100K gain, which means you really didn't make $100,000. You made $75,000 and the government made $25,000. Now, if you're like, how do I keep all of that, Matt? How do I make 100K and keep 100K? That, my friends, is using the Roth IRA, where you get to keep every penny and it's coming to you and nothing is going to the IRS or to the state. Now, remember, that gain that's happening in the Roth IRA means that I can reinvest every dollar to keep growing and building the account, and every penny is compounding and growing. And later on, when I want to pull that money out and realize all of this gain, there is no tax on qualified distributions at retirement. What is a qualified distribution? You've had a Roth IRA for 5 years and you're at least age 59 and a half. Now you've got qualified distributions coming out entirely tax-free. Now, I can't just buy crypto in a brokerage IRA. It's a Charles Schwab, nor can I buy it at my bank or credit union or the insurance company where I might have a Roth IRA. But this is a particularly powerful strategy when you are buying crypto that you know and believe in, right? We want to invest in the assets we believe are going to grow. But I have to have a provider that will let me own these assets with a crypto IRA. And that brokerage company, the bank or the insurance company where I have my IRA, they let me buy what they sell. They don't sell crypto. Now, maybe they sell an ETF, the Bitcoin ETF, let's say at your Charles Schwab brokerage account, you could buy that. And maybe they even have an Ethereum ETF. But if you want to have all access to any crypto and you want to own the actual cryptocurrency, that takes a self-directed IRA provider like our company directed IRA, and you would use what we call a crypto IRA. Now, I'm using that same Roth account structure that we've been using for stock and real estate and other assets for years, but I'm using that same account structure to go buy Solana, XRP, Bitcoin, Ethereum, 50 other cryptocurrencies. Okay, you can own all of these cryptocurrencies in a crypto Roth IRA. And of course, you want to invest in the asset that you know and believe in, that you believe is going to have the highest growth over time. Now, the crypto Roth IRA is a structure that we've created with Gemini. So when you open a crypto Roth IRA with directed IRA, you can make a new contribution, say $7,500. But what most clients do is they transfer existing funds over. They've got that Schwab IRA, they've got the IRA at their bank or whatever, and they're like, I want to buy XRP. I think that's going to go up. Or I want to buy Solana. How do I buy 50,000 of that with my Roth IRA? Well, you open a crypto Roth IRA with directed IRA. We transfer over 50K from your IRA at your bank or credit union or your brokerage IRA. That then hits your crypto Roth IRA directed. Then you go buy the asset that you're intending to here, XRP, Solana, whatever cryptocurrency you believe is going to have the greatest upside. Now, I'm repositioning at an opportune time. And I'm talking about this now because crypto markets are down. When do you want to buy assets? Buy low, sell high, right? Everybody talks about new highs. And whenever there's a new high, everyone gets excited, right? But what does Warren Buffett say? He says, be aggressive, essentially, or I should say greedy when others, I think the quote is, be greedy when others are fearful. Right now, others are fearful. Crypto is sometimes a momentum trade, like it swings big time based on certain momentum and sentiment. But over time, it eventually settles back out. And that could be months, that could be years. Who really knows the time horizon here? And nobody knows what's going to happen to crypto. But I'm saying there's been something big today. There's an opportunity to maybe take advantage here. If you believe in the long-term value of crypto, crypto is on sale today. All right. You can lock in, you can buy low. And then when the headlines are crypto new highs, you will feel like a genius because now you can be selling it later on, of course, when you hit 59.5, out of your Roth IRA entirely tax-free. So some people have been on the sidelines for a long time about crypto. And they've thought, oh, it's too expensive. That could be another person that thinks, maybe now's the time to jump in. If you've been waiting, trying to time the market, which many times is foolish, but if you've been trying to time the market, now might be a time to think about jumping in or increasing that allocation. Now, you could be like, Matt, I don't believe in crypto. I always thought it was bunk, thought it was going to be a fad. It's going to go away. This is not for you. I'm not trying to convince you of your opinion on crypto and its value. I'm just trying to convince you on how to do it strategically in the most tax efficient way. That's all I'm trying to make here. But right now is an opportune time because of the pricing changes. Whether you're trying to reposition, and lock in losses using crypto tax loss harvesting, or whether you're trying to get more money in using your Roth account, Roth IRA, this could be Roth Solo K, this could be a health savings account, whatever tax advantage account you want to use, you can use that account to invest in crypto. Now's an opportune time because crypto is on sale, lower value. Hopefully you can realize greater appreciation over time. All right, so that's the two opportune strategies. Tax advantage accounts, the most common one is the crypto Roth IRA, and then crypto tax loss harvesting. Think about those today and over the next few weeks. Who knows what's going to happen? Maybe this window closes. Maybe it stays open for a really long time. I don't know. No one knows. Anyone that tells you that they know, stop listening to them. Just whatever else they say, just stop listening to them because of course, nobody really truly knows. All right, well, let's pause here because now I know we have questions.
We do.
On crypto Roth IRAs. We've got thousands of clients that have bought crypto in their IRA. So let's see what questions we've got today.
Okay, we've got Eduardo J. Sanchez, PA. If we use the first strategy, should we not buy back into a Roth IRA instead?
I like it. Why not do both? That's basically what he's talking about there is lock in the loss now, and but let's rebuy it in the Roth IRA. Now, if you have money in a Roth IRA, yes, I like that. Now that might mean your Roth IRA owns a target date fund or a mutual fund. Okay, that could be you're gonna have to sell that, which means you believe the crypto is going to do better. So I like that concept and strategy. Absolutely, you could do both. It's not one or the other. You could also do both in the sense of rebuy personally and then make new acquisitions using the Roth IRA. I'm not saying you need to exit your personal holding to then buy using the crypto Roth IRA. These are two separate concepts, but both, of course, could be used. So, but now some of you might not have any money in a Roth IRA. Well, you could at least put $7,500 in as a new contribution. Those 50 older could do $8,600. These are 2026 rules. But if you didn't make a contribution in 2025, you could make that contribution too. So let's just say you're a married couple. Neither of you contributed to a Roth IRA in 2025 and you haven't contributed in 2026. Well, you could put in $7,000 for 2025 as a new contribution into a Roth IRA, $7,500 for 2026. That's $14,500. Your spouse could do the same. And let's assume you're both under 50 here. Now we're talking $29,000 in Roth dollars that could be used to go and buy crypto. So that's just under new contribution rules. Now, if you're a high income earner, you may have to do a backdoor Roth IRA. We talked about that on the last Wealth Office Hours Live. So go back to that one. If you're like, Matt, I make $200,000, $300,000 a year. You might need to do something called the backdoor Roth IRA, which is alive and well. We do that every day here at Directed IRA. And go watch the last Wealth Office Hours Live where we explain that strategy. But that backdoor Roth IRA could also be used to buy crypto as the investment asset. All right, we got some other questions that came in too about staking crypto. And let's come back to the next live question, Jordan, after this one. But this one was from Aaron Samuels 1 and said, am I allowed to stake crypto that's owned in my IRA LLC institutional account? Now, when you're buying crypto, we really have two different structures that we do and that are really out there in general in the crypto IRA market and strategy. The first is what we call the crypto IRA, where you simply have a Roth IRA or other type of tax advantage account. It could be a traditional IRA, a solo 401k, an HSA. You can even have a kids Roth IRA for your kids, whatever it might be. But that account is linked to a wallet with Gemini. That's our partner in this. Gemini is one of the largest exchanges, publicly traded, audited, examined by a banking department. They have large controls and stuff, but your account's linked to there and you're buying and selling with a Gemini wallet and you're on the Gemini exchange. All right. Your Roth IRA owns that wallet. You don't own it. Your Roth IRA owns it. That's the general crypto IRA structure. And we'll put any details on that and pricing in the chat there for any of you that have questions on that and how that structure works. The second structure is kind of the old school structure, which is rather than a crypto IRA that's kind of tailored and linked to a specific wallet and integrated and all that, what we do is we have your self-directed IRA own an LLC 100%. That LLC creates an institutional wallet. So your IRA, including a Roth IRA, can own an LLC 100%. You can be the manager of the LLC. It's called an IRA LLC or checkbook IRA. Now, a lot of real estate investors use that structure, but crypto investors have adopted it as well. Because what they'll do is they'll take that LLC bank account and they'll link it to an institutional wallet. So they'll create an institutional account, which you can do with Gemini. We have a relationship with them as well, where we can create an institutional account where you'll have an institutional wallet linked to your bank account for your IRA LLC. Now, if I just lost you there, don't worry. It's kind of an advanced structure. Just do the crypto Roth strategy. It's much simpler. But if you want to get a little more advanced, this IRA LLC structure has some benefits here, one of which is relating to this question. So yes, you can stake crypto owned in your IRA LLC institutional account. You can also take that crypto off exchange. We had other people ask that question. Meredith Blake asked that question. Can I transfer crypto from my IRA LLC institutional account with someone like Gemini or Kraken to a cold wallet in the name of my IRA LLC? Yes, you can. You can take that off exchange to a cold wallet that the LLC owns, and don't mingle personal crypto on that wallet. And you can bring it back to the exchange when you want to sell it or make any trades. So that is something possible using this IRA LLC institutional account. Is you can get your personal hold of your crypto. Now, that strategy and going off exchange there and using that cold wallet is not IRS approved. And frankly, nothing is IRS approved. But I will say that is a pioneering strategy. Okay. I don't know how that's going to come out in tax court. I think you're okay, but we're not certain on that. There's not any guidance on that or indication of how that will be treated. Right now, there's no rules prohibiting it. So we let clients do it if they want. But I just like to say you're pioneering that strategy. So if you want to go off exchange and hold your keys, you need the IRLC structure. And just know you're in more of a pioneering strategy and structure when you do that. All right, let's see any other live questions, though, that we might have. I want to make sure anybody on live gets an opportunity to ask their questions. We have others that people send in, of course, that I want to hit to if we have time. But anything else?
So we just got one in, and this is a rough one that I never like to hear, but I mean a good one, and I think it's going to be good for anyone to learn that's ever dealt with this. So David Neely asks or mentions, I lost about $50,000 in 2025 through a crypto scam. Is there a tax strategy that could help me?
This is a very complicated area in the tax code. So when you lose an asset due to theft or a scam or fraud, it's a different set of tax rules than the regular loss rules. We have dug into that, and even Mark and I did a podcast episode maybe 2 years ago about this on that would probably be a great reference point if we could pull that and share that. Is if you've lost money on an investment for scam or fraud or something like that, how do you take a loss? I don't know if it's just a big portion of our open forum, but we've addressed this before. We actually did some research on this. I haven't looked into this for a while. I just know it's a different set of rules. There are some options on how you can take that loss. What I will say is it's going to get bottled up, though, with other to offset future investment gains. You won't be able to pull it over onto your 1040 where you might have wage income or business income. So I'm sorry if it's a little unclear answer there. I just don't have a quick reference point on it. I do know there are definitely some rules on it. And it's different than just saying it's a loss on my Schedule D and I'll report it at zero, like I sold the asset for a loss. It's a little different set of rules in how you do that. So we'll see if the team can find that. I don't know. We have a lot of podcast episodes, so I can't even remember which one, and I was even in it. So so we'll see what we can do. Though
we're on it.
Okay,
we're finding it.
All right. Another question that came in on this topic, though, in advance was from Katra Appa, which says, why can't I transfer crypto from my crypto IRA to my personal wallet? Well, Under the crypto rules, there's something called the prohibited transaction rules. That is essentially a rule that says you can't transact with yourself. So if I have crypto in my IRA and I then move it to a wallet I personally own and control, the IRS deems that to be a transaction, and I transacted with someone who is a disqualified person, which is you, your spouse, your kids, your parents. There's a certain group of people that you can't buy or sell assets from your IRA with. You're the first person on the list. That is why you cannot transfer crypto from your IRA to your personal wallet, nor could you go the other way, where you transfer crypto that you personally own over to your crypto IRA. So when we're talking about this strategy and using the crypto IRA, I'm talking about buying new crypto. All right. I'm not talking about moving that crypto you already own to your crypto Roth IRA. I'm talking about buying new crypto using the crypto Roth IRA or the other tax advantaged account, like I said, whether it's an HSA, traditional IRA, whatever it might be that you want to use. All right. If we have no other questions here.
No other questions.
I want to hit just a couple other tax strategies to think about here, in addition to the tax loss harvesting, the crypto Roth IRA strategy that are opportune for now. But I just want to hit two other crypto strategies that I think are really kind of foundational to be used, but come with some other risks and warnings that are actually applicable today too. The first one is what I'd say strategy number 4, which is borrowing against crypto instead of selling. This kind of buy, borrow, die strategy, is sometimes it's called, is like buy and accumulate assets, don't sell them where you have taxable gains, borrow against them, and then die, and your heirs get a step up in basis and they inherit it at fair market value, which means they can sell it and pay no tax at all on the gains. Okay, that's this buy, borrow, die strategy, which is a great strategy. We just don't have money people taking us up on the die part. It will happen, but the buy and borrow part people love. It's that die piece that just, is a little tough to convince. So, but on this strategy of just like borrowing against it, remember, when you borrow against an asset, that is not income. You're not selling the asset, it's debt to you. Now, a lot of real estate investors use this to draw equity out of their properties. They don't want to sell the asset. They think it's a great asset. It might be cash flowing. It's appreciating over time. Why would I sell this thing? It's got great value. Well, I want to access that value. I've built a large portfolio of these assets. Okay, let's get loans against them and draw out the debt. Not only am I continuing to accumulate wealth, so long as that growth, cash flow, appreciation is outpacing the cost of debt, but I also am not paying any tax. Well, you can do the same thing with crypto. There's a lot of lenders that have came out that will lend you money based on your crypto portfolio. Now, right now, with the volatility in the crypto market, that's a little scary, quite honestly. If you took on a lot of debt, and there's many hedge funds out there that are feeling pain right now that are being forced to sell their positions because their values have gone down so far that the bank is owed more money than their crypto is worth. So you've got to be careful about that. And it's an opportune time now to mention that, of course, as there's been volatility in the crypto market. But the strategy is viable nonetheless. Like, I can still borrow against it and it's not taxable. Just want to note that strategy. And there's actually been more and more banks and lenders that are lending against crypto, from the big institutional ones like JP Morgan and stuff down to many other smaller lenders and providers that will lend you against your crypto assets. All right, the other one here. This is for any of you that have made $1 million plus on crypto, whether it was in the past, or excuse me, I should say, whether this is something you're planning to do right now, or this is a future strategy you're thinking about. You've built a large crypto portfolio that you own personally. Okay. There's a strategy called a charitable remainder trust, or CRT. What that strategy involves is you don't sell the crypto. You donate the crypto effectively to a charitable remainder trust, a CRT. The trust sells the crypto tax-free, because this is a charitable trust. The money goes back into the trust. You got a tax deduction for the contribution. There is also an income stream that you were able to get from the trust to you during your life. There's a lot of different ways this can be structured. There's other content we have on this, and there's attorneys in my law firm, KKOS lawyers, that structure this and strategize on these if you want to consult. But basically, it is a way to avoid the gain on the sale of the asset, get this asset out of your estate, also for estate tax purposes, give yourself an income stream over time, and also buy a life insurance policy that reimburses your family back essentially on the value of the portfolio when you pass away. In other words, it's a way to pay no tax, get a charitable deduction, get an income stream over time, and let your family still get the value of that wealth in the form of life insurance policy. And then the charity at the end of the day is going to get the corpus of the trust proceeds, which will be invested after you sell that asset. They can be invested into other assets. Now, this is a complex strategy. You're not doing this when you make tens or hundreds of thousands of dollars in crypto. This is a million or more type I've made in crypto type strategy. It requires careful tax and legal planning. Your lawyer needs to be involved. Your accountant needs to understand what's happening so that this gets done properly. So not something you might be thinking about today with the market being down, but as we're talking about tax strategies, this is one we've done for a lot of clients that have frankly done very, very well in crypto over the years. So I just want to get that out there. It's the CRT, or charitable remainder trust. Max Merritt's one of the lawyers in our law firm, KKOS Lawyers. It's done a lot of them with my partner, Mark J. Kohler. There's other attorneys in the firm that have worked on them as well, but we got resources there if you need it and you want to implement that strategy. Okay. Let's move on to take it or leave it. This is a section we have. This is where I'm going to give my opinion about some social media commentary that's out there in the TikTok sphere, where people are trying to tell you what you should do with your money and telling you about retirement accounts or tax strategies, other things out there. And what I've learned from the 30 minutes I spent on TikTok before I almost deleted it from my phone. And yes, I know I do have a TikTok account, but I don't understand how it works. My staff does it. Don't message me there because I don't even know. Can you even message on there? I don't know how it works. Okay, I'm just admitting this. So, but apparently it's a thing and people watch it. Okay, so let's see the advice here coming from TikTok.
An IRA is a scam account. It's a crypto Ponzi scheme, except based on the stock market, where you lock up your money for 60 years of your life and you can never take it out unless you want to get taxed aggressively on it. And hopefully, by the time you're 60 years old, there hasn't been a huge economic crash, right? Because if you turn 60 in 2008, well, guess what? Your IRA's royally.
Okay, all right. Excuse the F-bomb there, everyone. But what I'll just say on this clip is there is so much misunderstanding about retirement accounts, and this guy has no idea what he's talking about. Okay. He specifically talks about a Roth IRA. All right. Remember, the Roth IRA is the one account you can make a contribution to and pull the money out tax-free whenever you want. So for example, let's say that over 10 years, I put $7,500 a year into my Roth IRA. It's now $75,000 of contributions, but because of earnings and growth, it's really worth $125,000. I've had $50,000 of growth, 75,000 contributions, 50,000 of growth. The account's worth 125 grand total. Well, that's 75 grand that I put in as contributions. I can take out whenever I want. All right. If I put that $7,500 into my bank account and I pulled it out, it's the same thing. If I put $7,500 in my Roth IRA and I want it next month, next year, in 10 years, I can take it out whenever I want. It is only the earnings and gains that you cannot pull out until you're 60, as this guy says here. Now, making money investing is hard. Let's not be trivial about it. It's hard to make money. The best way to ensure you're growing and building wealth is to start early, start accumulating, and let compounding work over time. All right. There's no such thing as a 100% return. All right. Those things are very rare. We need to focus on saving money in an efficient way. And I think the first $7,500 you make should be going into a Roth IRA. Why? Because that's the one account where it's going to grow and come out entirely tax-free at retirement. And for any of you that are high income, we're even told you can't do a Roth IRA. You can do the backdoor Roth IRA. Okay. Again, that was the Wealth Office Hours from last week. Now, final point on this. On that rule where you pull money out, that your contribution anytime, For backdoor Roth IRAs, the rule is a little different. Remember, when you put money into a backdoor Roth IRA, it's a non-deductible traditional contribution. You are converting to Roth. It's not a regular Roth contribution you can pull out. It's a Roth conversion. Roth conversions have a 5-year rule from when you can pull it back out. The earnings and gains, again, you still got to wait, but that contribution you put in has a 5-year window from when you get to pull it out. So just a little caveat, a nuance on pulling backdoor Roth IRA contributions back out versus standard Roth contribution. So might be a little nerdy, but I think at least one person watching appreciated it. All right. Let's move to the Q&A section. If anybody's got any live questions, this is the part of the show where we want to answer your questions, whether this is on tax planning, legal strategies, estate planning, retirement accounts. Don't ask me who's going to win the Super Bowl. I had to ask my team today who's in the Super Bowl. Apparently it's the Seahawks and the Patriots. And Tom Brady no longer plays football. That's what I learned today. Okay. But I guess he's still on TV talking about it. I don't know. All right. Who's got questions? Don't be shy, guys. I want to hear your questions. And other people might be listening. They're going to benefit from this. So please let me know if we can help.
Any topic, too.
I don't
Almost
care.
any topic. Under the
Not
sun.
about who's going to win the football.
Maybe not sports.
I mean, I'll tell you what I think. It's just not going to be valuable. If you hit it in the lanes here of tax, legal, retirement, wealth building a business, scaling, I don't care. I might have something helpful to say. And keep in mind, please be commenting on the videos. We actually pull a lot of the questions that determine what we're going to talk about on the show and that we weave in through the show from the good questions. A lot of people are liking those questions and wanting those questions to be answered on the videos. Thanks for everybody who's subscribed to the YouTube channel. It's kind of, we're trying to listen to you in the comments and in the interaction of what you think would be helpful and wanting to learn. And a lot of the questions that we weaved in today on the crypto IRA structure and everything was from questions just sitting there on the YouTube channel that we wanted to address here. So, all right.
So we've got Hockey for Life. They ask, can I move crypto that I personally own into a crypto IRA?
Okay. I know this is the burning question, and I wish we had a way to do this, but the answer is no. The crypto that you personally own right now, I would think about the crypto tax loss harvesting rule. If you believe the crypto is going to still go up in value, which I presume you are based on the question here and about getting it to your Roth IRA, what I would think would be the more viable strategy is the first one we talked about. Sell the crypto, assuming you bought it at a higher price. Maybe you bought that crypto at 40,000 per BTC. They don't do anything. From a tax strategy standpoint here is because you're going to have a gain. But if you bought it at 80 per BTC or 100 per BTC or more, you've got a loss that we can lock in here and you can use on your 1040. Even if you rebuy that crypto immediately right back, remember. So I think that's just a strategically tax smart move to do right now. But we can't move that exact crypto over to a crypto Roth IRA.
Okay, we're going to go, we've got wildcard questions now. So we're going to go off of crypto for a
Okay,
second.
all right. That's fair. Let's do it.
So Eduardo has another question. If I invest funds through my Roth IRA into a lending investment club, would this trigger UBIT tax if I get reported through K1s from the partnership?
Okay, it depends. Sorry, that's the number one lawyer answer. That's the first thing I learned in law school is when you get called on, you have to say it depends. And then you have to clarify some facts with the professor and then you give your answer because they're always trying to trick you. But here's the what it depends on. If that lending fund just collects, let's say, I'm just simplifying here, but let's say there's 100,000 or let's say there's 1,000 investors in this thing that each put in 100 grand and there's, what is that? $1 billion? I don't know. 100 million, whatever that number is. Okay. And they've all collectively invested in that fund. And just the cash that they put in is what is lent out. And then you're getting interest income back, and you're getting a K1 for your share of the interest income back. And that's going to your IRA. No UBIT UDFI tax. I'm not worried about that tax in that scenario. But let's say all the money that's invested from the different investors into the fund is then leveraged with debt. And let's say that they raised $100 million, but that they also got $100 million of debt. And so they're lending out $200 million. Now you have UDFI tax, unrelated debt financed income tax. So some funds will use debt to leverage the return that they can get, because they might be able to lend out this money at 12%, but they can get more money to lend by borrowing it at 8%. So just take that into account when you're looking at the fund. Are they using debt to leverage? Some do, some don't. It just depends on the structure and the investment group that you're working with.
Okay, we got a good question about kind of the order of operations for how we pay off debts here.
Okay.
I want to pay off, this is Jennifer 9912. I want to pay off my mortgage. I have very few debts, but they aren't big like my mortgage. I know you pay off smaller debts first, but the mortgage really bothers me.
Okay. All right. I love this question. All right. I want to know, and let's see if we can get a quick answer to this. What is the rate of the mortgage? Okay. That matters here in my answer. Now, Dave Ramsey basically does what he calls the debt snowball. And he says, take your smallest debt and focus on paying that off first. So let's say you've got a mortgage for 500 grand. You've got a car loan for 20 grand. And you've got a credit card for 10 and another one for 5. What Dave Ramsey says is focus every available extra penny that you might have to pay off the 5,000. Do the minimum on everything else. And this is irregardless of what the rate of interest is. This is his recommendation. The reason he recommends that, and the reason Dave Ramsey has been a wizard on how to pay off and save money and build wealth by getting rid of debt, is because there is a psychological win in paying off debt to where it's gone. It's a huge win. You pay off that $5,000 credit card, you feel like a champ. Paying off the $500,000 mortgage is going to take a long time. This is regardless of rate. So then he's going to say, go to the next smallest one, the $10,000 credit card, then pay off the car loan. Then you get to the mortgage as the last reference point. Now, a lot of times, naturally, the larger balances are your mortgages at lower rates. The medium balances are your car loans at medium rates. And the highest rates are your lowest balances, your credit cards. And so a lot of times his strategy naturally works because that $5,000 and $10,000 is the 15, 20% credit card rate, that you're paying versus the lower rate on the mortgage. So sometimes it works that way. My opinion is that you pay off the highest rate balance and apply your additional income to the debt that has the highest rate of interest. Mathematically, you win on that. It's not psychological where you get done with one and everything else, but it mathematically and just from a pure net worth calculation of how your net worth is improving year over year, you win there. So for example, maybe you've got student loans at 10% interest, but you've got a mortgage at 5%. We're going to be paying off the student loans a lot faster. And these may be private loans, whatever, when I'm giving that 10% rate. So I'm always going to focus on paying off the high interest debt first. My opinion is a mortgage at 5% that it sounds like is what you have. I don't even think I'd care about paying that off. I know you might want to pay it off, but my question is, think about this as do a net worth statement. This is what I would recommend. Write out your assets and write out your liabilities. Say, how much assets do I have? What's the value of that real estate? Let's say it's, $700,000. The mortgage, $500,000, and it's at 5%. All right. Well, I've got $200,000 of equity there. Write out your other assets you have: retirement accounts, rental properties, investment accounts, precious metals, crypto, whatever it might be, right? Let's add it all up as an asset. Then add up your other debts that you might, maybe there is a credit card, maybe there is a student loan. I don't know. But if there's debt on your balance sheet above 5%, pay that off first. If you're like, man, I've paid off all my debt, I just have this big nut of my mortgage that's at a 5% rate, I would probably say, don't stress. There are very wealthy people with hundreds of millions, billionaires that have mortgages at 5%. They might get a little bit less, and especially those that locked in on earlier times. But why are they not paying that off? because that money they can apply, let's say $10,000 in the year you could throw at this extra, you could otherwise invest and get more than a 5% return. So if I took that same 10,000 and I invested in the S&P 500 fund that at least got me a 10% return over the last 20 or 30 years, my net worth is getting better. I'm actually improving because the investment returns I can get outpace the cost of the debt at 5%. Now, if your mortgage was 7% or 8%, I might be like, I can see that. Maybe let's work that down. But if you can beat the cost of the debt by investment rate of return, I would focus on growing and investing those extra dollars as opposed to paying down the debt. All right. Great question, though.
Okay. I think we have a good one to end it on here.
All right. Okay. Final question.
Love your content. Who do you follow for good advice? Obviously, in take it or leave it, we've seen a lot of bad advice. Who are you following for good advice?
Oof, that's a great question. Let's just look at my podcast history. Of course, I listen to Mark J. Kohler and anything that he puts out. At Mark J. Kohler, you find his YouTube channel. That's, of course, my partner. We do 2 podcasts together. I'll go to my podcast. Okay. Your top shows. I listen to All In Podcast. That's the #1 podcast I listen to. It's a little bit global, politics, investing, technology, interesting show, smart, sophisticated people that run it. The Wall Street Journal. I listen to The Compound and Friends. That's Josh Brown, Michael Batnick. They have other cast of characters. They're more investment advisors. Masters of Scale. Okay. Masters of Scale is more about how to grow and scale a business. And it's Reid Hoffman and some other smart people that do that. Bloomberg Odd Lots. I listen to that one. So I'm a podcast guy. I also listen to This Week in Startups, the Apollo podcast, Goldman Sachs podcast. I'm a podcast junkie. So that's mostly where I consume content. I actually personally don't watch a lot of social media. My team has to give me these TikTok stuff because I don't I watch YouTube. I should say that. So I recommend those sources.
Awesome.
So, all right. Some good recommendations there, hopefully. Well, thank you everybody for tuning in to Wealth Office Hours Live. Remember, we're here live every Thursday at 4 Pacific time. And please subscribe, turn on notifications so you know when we're going live, and come with questions. I'm here to answer the questions. I appreciate those that came out and asked the questions here while we were on live. Those are awesome and great questions. That's the purpose here. I want to help you as you're trying to learn, grow, and build wealth, whether it's tax strategy, legal planning, your estate, building your wealth through retirement accounts, whatever it may be. I want to help be your resource and give you that advice here every week on Wealth Office Hours Live. We'll see you next time.